Good evening, everyone. I'm Debbie Schwartz, founder of Road to College, and I'm here tonight with Chris Abkarians from Juno, and you're going to learn more about Juno and how they help in the student loan process. Let me just do a little bit of housekeeping. I'm going to put Chris on. I'm going to spotlight you so people can see you when you talk. I'll give myself a spotlight. Great. And before we get really into the discussion tonight on student loans, we'd love to hear a little bit about the people who are watching. Thank you for those of you who have your video on. It's nice to see people's faces. But this is run as a meeting. So unless you really want to ask a question, which is also fine, and you want to unmute yourself, if you keep yourself muted in the meantime, that's better. And feel free to put any questions in the chat, but let me know. I'm assuming that most of the people watching have a student who has just graduated, who's going to start college. So just confirm that for me. Tell me where you're watching from. Tell me where you are in this, kind of, I call it the last phase of the process, figuring out how are you going to pay the tuition bill. Actually, one quick question I'd love to know is, has people actually gotten the tuition bill yet? Because a lot of schools have not yet sent them out. That's usually kind of what happens in July timeframe. So let me know if you have or haven't gotten the bill, which is kind of a little bit of an eerie feeling, not completely knowing what the final cost is going to be because you haven't gotten that tuition bill yet. But we will help you as much as we can tonight, which I think is a lot, to help explain the loans that are out there. And then again, Chris is going to give you some really great information about his company and how they are truly helping families get the best rate out there. So let's see. So people from Dallas, New York City, Albany, Pennsylvania, Minnesota, California. Wow, all over the place. I'm not surprised. I see most of you have not gotten the bill yet. So my words of advice are to really enjoy the July 4th weekend before the mail comes next week, or the middle of July, when probably that bill will come. So, okay, great. Well, and we have a pretty nice turnout tonight, to tell you the truth, considering it's the end of June. We're going into the holiday weekend, and I can't blame any and everyone if you just want to be outside and you're tired of Zooms. I hear it, but I know that we have some good information tonight. So, Chris, you want to say a quick hello and maybe just a little background about yourself before we go into the slides?
Yeah, happy to. Thank you, everybody, for being here. My name is Chris Abkarians, as Debbie mentioned, and I'm currently in Boston. My background and reason to be here is I started a company called Juno that we'll talk about a bit later. It initially started while I was in business school, getting my own student loans and banding together a couple of hundred of my classmates to create actually a collective buying group to see if we could convince lenders to lower the rates that they would charge us. And we've since expanded that out to about 100,000 people now. And so I had to get student loans for my undergraduate studies and for my business school studies. I consider myself an expert by practice, not by wanting to. So glad to be here and look forward to trying to be as helpful as possible.
Okay, great. So let me share my screen and we will get going. Okay, just some thumbs up from somebody just to make sure that we can see the screen. And let me get my chat back on. Okay, great. Okay, so as I mentioned, we're going to talk about student loans. Then we're going to talk about, how we can help you shop around and make sure you're getting the best rates. Let's just, oops, am I going the right direction? We introduced each other, and I don't need to really say this more because we all know it. Paying for college has become a huge financial decision these days. If you're here, I know that you've done the best you can through the application and the search process to really find a school that's affordable as possible, but a lot of families still can't, afford outright the whole tuition bill. And so we're going to talk to you about what student loans the government offers, and then what your options are after you've exhausted the federal student loans. But we are going to start with the federal student loans to explain to you all the different types of loans that there are, and the importance for why your student should be using the federal loans to the max. So the first type of federal loan to talk about is what they call the direct federal student loans. It's also known as Stafford loans. That's an older term. And what's so important about this loan is it's probably the only loan out there that your student can get that's only going to be in their name. So it means that there is no cosigner needed, and your student is solely responsible for whatever money is borrowed. Everybody in this industry, in this space, will tell every student and every family that students should max out whatever they can through the federal direct loans. Unfortunately, there are maximums, and we're going to tell you what the maximums are. So even though they've taken all the loans that the federal government can provide, they still might need to borrow more, and that's where we'll explain the other options. But without a doubt, every undergraduate student should take the federal direct loans up until the maximum that they can. And here are the limits by year that a student is allowed to take out. Freshman year, it is $5,500. Sophomore year, it goes up to $6,500. As you can see, junior and senior year is $7,500 each. What's really important to understand, and I get this question a lot, is what if my student didn't take the loan out freshman year, and then we only take the loan out in sophomore year? Can they take out a larger amount because they didn't take out their original $5,500? And unfortunately, that's not the case. So you have to use it the year that it is available. And that actually goes to the point of really understanding what your students and what your 4-year costs are going to be. And so unless you've planned out your costs for 4 years, you may not realize how important it is to borrow the federal direct loans every year. And if by chance in junior year or senior year, you realize that you can pay back the money, you can always pay off without a penalty any of these loans that were taken earlier. But again, you can't go back and ask for the money if you didn't take it out in the year that it was offered. So that's the importance of really understanding how much money your student might need to borrow every year. And again, always maxing out the loans that are being offered from the federal government to your student. So the loan rates have already been decided for these student loans. And for this coming year, any money that is dispersed after July 1st will be at an interest rate of 4.99%. And it does have a small origination fee of 1.057%. So this is actually a fixed amount. So for the life of this loan, and the federal direct loans have a 10-year term, the rate will always be, for this loan, will always be 4.99%. But next year, when your student takes out a loan, or takes out this federal loan, let's say for the $6,500, this rate will be different. We don't know what it's going to be because every year, actually, this rate is set by Congress, usually in the June timeframe. So unfortunately, your student does kind of collect several different loans through their life if they're borrowing every year. But whatever the rate is at the start of that loan for this particular loan, it is fixed for the life of the loan. And Chris, feel free if there's anything I'm missing, like to just chime in.
Maybe just really quickly to add some other reasons why folks would say that this federal direct program is the starting point is, first of all, there's no credit qualification to get this 4.99%. I saw a question.
I'm just seeing that now. Yeah.
About why would someone take an unsubsidized loan here at 4.99 if you can find a better rate through the private markets? that may be possible for you to do, but it's very unlikely that a student borrowing by themselves would be able to qualify for a 4.99% fixed rate anywhere else. And so for a student borrowing by themselves, this is almost always the lowest cost loan that exists. And another thing to take into consideration is if you're comparing it to a private loan, there are meaningful protections if your student, let's say, has something happens and there's a disability after graduation, or is unable to find a job that lets them pay back the full payments for this loan. So there are different repayment types that students can opt into through the federal government that will limit the amount that they have to pay upon graduation to a percentage of their discretionary income. And that's a feature that really is only available through a federal student loan. So, and then the last thing I would just add is no one has a crystal ball and really knows if there will be any degree of student loan cancellation or forgiveness. But if there were at some point, this is the program that most pundits would expect would be forgiven first. And so it's just something to take into consideration as you're thinking about what decision to make.
And somebody else asked, is each year a separate loan or is it put into the original loan? Each year is a separate loan. It's at a separate interest rate. You're going to have to, sign the document separately. Ultimately, when your student graduates, they can do something called consolidation. But right now, as they go through college, it would be separate loans each year. So I did mention the origination fee. There is an origination fee on the federal direct loans that we just talked about, and there is an origination fee on the Parent Plus loan. And that's why I wanted to bring it up before we talk about the Parent Plus loan, because it's actually for the Parent Plus loan, it is a significant percentage. And that is one of the reasons why a lot of people compare the Parent Plus loan to other options, because when you add in the origination fee, it becomes a more costly loan than the direct federal student loan that we just talked about. But basically, an origination fee is some form of a disbursement fee. And so the example we gave, if you are borrowing $1,000, you're going to pay interest on the $1,000, but depending on the origination fee, you're actually going to be netted less than the $1,000. So, it's like a fee like anything else. It's taken off the top, but you end up paying interest on the full amount that you've borrowed. So that leads me to the Parent Plus loan. We talked about the federal direct student loan. Again, if your student needs any borrowing, they should be going that direction first. And then the other types of federal loans that are offered are Parent Plus loans. The one thing I wanted to bring up is a lot of people probably have seen their, the financial aid award information by now. Some schools include all of this loan information on their forms. Some do not. Some, in a slightly, and I will say tricky way, will include the Parent Plus loan as a line item on the award. And so that people get confused and don't recognize that that's an actual loan. But your decision to take any of these loans is just that. It's an optional decision. And once your student has maxed out the federal direct loans, we encourage, and we'll explain why, that you look at the Parent Plus loan, but you also look at the other options that are available and you make a comparison. But let me describe the Parent Plus loan, and then you'll understand how it might be different from the other options that are out there. So what is a clear difference about the Parent Plus loan is, as its name implies, it is solely for the parent, and the parent has the only responsibility. The student has no responsibility in theory to pay this back. You can make whatever arrangements you might make with your student, but legally, if you're a parent and you take out the Parent Plus loan, you are the person responsible for payments. Similar to the direct federal loan, there is a fixed rate. So regardless of your credit worthiness, everybody who takes out the Parent Plus loan is going to receive the same interest rate. And this year, that interest rate is 7.54%. And the Parent Plus loan, as I mentioned before, has an origination fee, and that origination fee is 4.228%, which is kind of hefty. I haven't done the exact math, but when we've done it in the past, if you looked at the effective interest rate, meaning you bundle in all the costs, and if you bundle in that origination fee, the effective interest rate would probably be over 8% for the Parent Plus loan. And so when you start comparing the Parent Plus loan to other loans, you shouldn't really be comparing the 7.54%. It's really, you should be comparing 8%. And I'll actually do the exact math and send it out in an email what that exact interest rate is. So that's the apples to apples comparison, is you have to bundle in all of the costs, in this case, the origination fee, and make that comparison. The one thing that I maybe didn't emphasize enough between whether you decide to go with the Parent Plus loan or whether your student, borrows the direct federal loans, is that your family needs to fill out Fafsa. Fafsa is the only way that you'll get access to any of these federal loans. And even if you were not eligible for any need-based aid, you might have, for some other reasons, decided not to fill out FAFSA because you knew that the college didn't need it, because you knew you weren't going to get need-based aid. But now you want your student to take out the federal direct loans, which is, again, an important loan to take out. Well, obviously, we've emphasized that a lot. You need to fill out FAFSA, and you're going to need to fill out FAFSA every year that your student is going to take out the federal direct loan, and potentially every year if you want to take out the Parent Plus loan. So that is, in my eyes, one of the real importance of FAFSA, and it's probably a major reason why so many organizations make sure that students are aware that they should fill out that form. Anything else, Chris, about the Parent Plus loan before going?
Just maybe two things I'd like to add here. So one is how much you can borrow, and two is when payments would start. So the cap on how much you can borrow through the Parent Plus program is the cost of attendance minus any aid received. So there'll be a number on the basically the paper you get back from the school that says how much you actually have to pay to go here. And so when you take a cost of attendance, which is defined as tuition plus some allowance for room and board and other expenses, the school comes up with this number called cost of attendance. And then you subtract out scholarships and grants, and that number that's left represents the cap on how much you can borrow through the Parent Plus program. And then on the second side, when you actually start making payments on this, by default, you're actually supposed to start making payments 60 days after the loan is dispersed, so the money is sent to the school. But you can request that you delay payments until after your child graduates. So if you do end up using this program, just know that you'll have to make that request, typically through your financial aid office, which will then allow you to defer making any payments until I believe 6 months after your child graduates. You'll still accrue interest during that time. So you might want to consider paying some of that so that the amount owed doesn't get too large. But just know that you need to make that request if you want to avoid making payments.
And so there's a question, where in FAFSA do we go to apply? You don't apply in FAFSA for these loans. You just have to have submitted FAFSA to then be eligible to take out the loans, and to then initiate the borrowing of these loans. You can honestly go to studentaid.gov directly, or a lot of schools allow you to initiate it through their financial aid portals. And I would really highly encourage, and I'm happy to answer whatever questions we can answer tonight, but to use your student's financial aid office now as a resource. Any questions, small or large, you should, go to them, and they can answer questions about the federal loans as well.
Yeah, Debbie's absolutely right on that. One more thing I'll just add is if you do have more specific questions, the sooner you ask your financial aid office, the better, because as we get towards the middle and end of July, they're getting more questions than they know how to handle. And so for the next maybe 1 to 3 weeks, you might still have enough time to have more personalized attention.
Yeah, that's a good point, because, and we'll talk about later about the process of loans, but they start to, the financial aid office starts honestly to get bogged down in the verification process of the loans. And so that's what really takes up so much of their time in July and August and beginning of September. Okay, so just, yep, go ahead.
Just one question here, which actually we'll answer on this page too, which is, when does the student have to start paying back the federal direct loan? That's 6 months after graduation, which is the second to last line here. Yeah, so this is just a really quick, we say, cheat sheet, just to summarize what we just talked about with federal direct loans. Right now they're at 4.99%. There's a small origination fee, 1.057%. The cap for freshman year is 5,500. You can see the rest of the table for the other caps. The rate is fixed. There's no credit check. This is solely in your student's name. There is no cosigner, and they can defer it they can start paying it while they're in school, but they can also decide to defer making any sort of payments till 6 months after graduation. This, again, I'm not going to, I've said it so many times, but I'm just going to reemphasize, if your student needs to take out a loan, every student should max out this loan first. It's without a doubt. Okay. And then as a summary for the Parent Plus loan, and then we're going to go on and talk about other options. It is currently at 7.54%. That's going to be fixed for the life of the loan, but there isn't this origination fee, and there is an origination fee every year you take out a Parent Plus loan. Which is the 4.228%, which makes this an expensive loan. It's a fixed rate. There's no credit check on your credit score, but there is a mild credit review for people who have had major bankruptcies or delinquencies. And the major issue with the Parent Plus loan is that it is solely in the parent's name. Okay, so actually, Chris had this as a decision tree. I kind of loved it because it helps you decide, what you should be doing and kind of the questions you need to ask yourself. So most everyone who's here today, your family needs to borrow for college. And so the first question is, does your student need to borrow more than the 5,500 for this year if they're going to be a freshman? If that's all they need to borrow, that is great. And really, as we keep saying, max out the federal direct student loan and you're done, at least for freshman year. But if you need to borrow more, the real major question you need to ask yourself is, who is going to be responsible for the loan that is going to be borrowed after the federal direct loan? So if you as a parent want to be solely responsible for that loan, then you can be looking at the Parent Plus loan, and you might actually consider comparing the Parent Plus loan to what is available called a private parent loan, which we'll talk a little bit about. But if you want to share the responsibility of paying with your student, which the majority of families do, and really which is the norm, then you are going to be looking at comparing the Parent Plus loan to another private student loan as the option. And we're going to explain how these private loans work, what goes into determining your interest rate, and other features that you're going to want to know about before that, so you can make a comparison and then how you can make a final decision. Okay, somebody's asking, what if you don't care whether the parent or the student is responsible? Which are better rates? We'll talk a little bit about that, and we'll talk a little bit about, how you figure out the rate. Because believe me, the number one question is, like, if people are asked, they're a little less concerned about who the lender is, and they're a little bit more concerned about just where can I get the best rate. And that's a fair question to ask. And we'll talk about, how you can figure that out. But when we're looking at private loans, there's two types of private loans, which I already mentioned. The majority of private loans are private student loans. And then there is also a type of loan called a private parent loan. So a private student loan is a co-signed loan. So that means it will be in the name of the student and the name of another credit-worthy adult. Most times it is a parent. It does not have to be a parent. It could be a grandparent. It could be another relative. But whoever that other
person is, you want them to be a worthy cosigner, because that's really the value of that person is bringing to the loan. It's really somebody with a good credit history, because as a student, we all know that the students just don't have that type of credit history that a lender can make a good decision on in terms of providing a good interest rate. So the better the credit worthiness of the cosigner, the likelihood that the better the interest rate is that the lender will offer. In most cases, as this comparison, most lenders on the private side do not have origination fees to their loans. So that's a big difference between the Parent Plus loan, that the Parent Plus loan has origination fee. Private student loan does not have origination fee. Parent Plus loan is in the name of the parent. The private student loan is a co-signed loan, which is in the name of the student and the cosigner. The private, go ahead.
I want to actually finish this, and then I just want to answer 2 questions about federal direct before we move on to the next slide, if that's okay.
Sure.
Sorry.
So private parent loans are really, I would honestly say, more of a niche product. A lot of families don't necessarily take out this loan, but it's worth explaining what it is. And it's not actually all lenders provide it, but a few do. And it's really for the family where the parent wants to still take full responsibility of the loan, but they actually have a very good credit worthiness. And because of that credit worthiness, they can probably get a better interest rate going through a private parent loan than compared to the Parent Plus loan. So that's really the major difference. It's a small number of people who do that. But again, if you are committed as a parent to have the full responsibility of borrowing and paying it back, it's something you might want to consider and compare against the Parent Plus loan. Chris, did you want to answer somebody's question?
Yeah, so I think I saw just 2 questions above from Sherry and Tracy. For a little bit more clarity on federal direct loans, when they accrue interest, and kind of when payments start. So there are 2 types of federal direct loans. Again, this is the one that your student takes out. So if it's a subsidized loan, you'll qualify for that by submitting Fafsa and having basically being deemed as having high amounts of financial need. And if it's subsidized, what that means is that loan will not accrue any interest until 6 months after your child graduates. And at that point, it will start to accrue interest and you'll have to start making payments. If it is unsubsidized, that's what we were talking about for the last couple of slides, where interest starts accruing once the money is sent to the school. Although payments on the federal direct loans don't start until 6 months after graduation. For that loan specifically, you don't have to request for payment to start 6 months after graduation. That's just the standard format of how it works. And then, so one more question from Craig on, are private loans paid directly to the school? Basically, in almost all circumstances, the money is initially sent from the lender to the school, and that's meant to initially pay for the mandatory pieces. So your tuition and the mandatory fees or health insurance if the school requires it. And if there's anything left over, that is typically put into an account by the school that you can access. And that account is what you typically use to pay for things like room and board or other expenses.
And then there's another good question from Lee. Can a student build their credit with one of the student loans? Does it help to build their credit? Absolutely. A student can build their credit with a private student loan because in fact, actually, one of the features, which we'll talk about in a minute, is a cosigner release. Usually the cosigner release requirements vary a little bit lender to lender, but what they're looking at is how much stronger or has a student become, or how much more responsible have they become in paying back their loan payments over a certain number of years. So having a student share and the responsibility of paying back the loan does build their credit and ultimately builds their credit history to the point where you as a cosigner could be released from the loan a few years after they graduate and they have a good enough income. Okay, so pre-qualification. I don't know if you've heard that term yet or not, but related to student loans, you can get a sense of what the interest rate is that you would receive from a lender. So right now you're probably seeing, if you're starting to look around, the ads for student loans, there's a huge range. It could be from because a lot of the lenders will quote a variable rate, which tends to be a little lower. So you might be seeing anything from 1% up until 11%. So that's a huge range, right? And so you have no idea what that means for you, because are you at the top of the range, the middle of the range, or the bottom of the range? But what you can do now is do what is called a pre-qualification, and the lender does a soft credit pull, which means that there is no impact to your credit score, and they will then narrow the range for you. They will give you a smaller range of what the potential is that the interest rate will be when you finally place that application. There is no harm to doing a pre-qualification. In fact, I really encourage everybody to do it. This would be an important step in the shopping process, and go out. There's you can go directly to lenders, and most of them offer pre-qualification. You can go to some of the loan marketplaces, and they will do it there, where you have to fill out one application and you might get pre-qualifications back from several lenders. But this starts to help you narrow down, which lender you ultimately might put in an application to. And when you do put in a final application, that's when a lender will do what they call a hard credit check, which might have a minor impact to your credit score. So you want to really kind of narrow it down to a few lenders when you're going to place that final application. The other thing that a lot of the credit bureaus realize is that families are shopping around. And so when you do that I don't want a final application where a lender is going to pull a hard credit inquiry on you, you can still there's still about a 30-day window where you can shop around for a few different lenders. So I say all this because I don't want people to be panicked that they have to pick the one lender, that they can only send in one application, and then they're stuck with that interest rate. That's not the case. You should have the freedom to shop around. The pre-qualification will have no impact on your credit score. So start doing that today, in all honesty. And then when you make a decision about which of the lenders, and I would narrow it down to a few where you want to get the actual interest rate back that that lender is going to offer you. You still have, a 30-day window once you start that application process to send in an application to a few different lenders and then make the comparisons. So what are the other options you need to be considering when you're looking at private student loans? One is the interest rate itself. You'll have the option to choose a variable rate or a fixed rate. The fixed rate, as the name implies, is going to be fixed for the life of the term. The variable rate will move up and down depending on what it is pegged to. Another decision that sometimes goes into whether or not a family wants to go with a fixed versus a variable rate sometimes depends on how long they might be taking out the loan. Variable rates do tend to be slightly lower than fixed rates when they start out. And if you may only need the loan for a short period of time because you might need to just borrow some money to cover before maybe some other funds come through, that's a potential reason why a family might be more comfortable taking a variable loan. If you don't want to deal with the ups and downs of interest rates, with, again, a lot of students and families feel that way, majority of students usually do go with a fixed rate because they are looking at paying back the loan over, a 5 to 10 year time frame. Another important feature to understand is the cosigner release. I want to say that most lenders offer cosigner releases. There is one major lender that does not. I'm not going to mention the name. I'm going to let you guys do your research and homework and figure out which lender that is. And that's not a bad thing. You just have to understand the risk that you're taking if you decide to go with a lender that does not offer a cosigner release. Most families want that cosigner release. They are fine offering their credit history to their student and helping their student get a lower interest rate on the private student loan. But then at some point, and it's usually a few years after your student graduates, they want to know that they can take their name off of that loan and that the loan becomes the sole responsibility of the student. So if you need to first question is, does the lender offer a cosigner release? And then the second question is to find out what the details of that cosigner release is. That does vary lender to lender. It could be the criteria will probably vary. The length of time over which a student might have to show a certain number of positive payment cycles will vary. A potential debt to income ratio will vary. So you want to understand those details. And I encourage everybody, kind of like the college admissions process where we all had tons of spreadsheets. I would do a spreadsheet for shopping for loans, put the name of the lender, whether or not you're doing a pre-qualification with them, what the pre-qualified range is, if you send in an application, and what the final interest rate is, and then what their information is related to all these features. So after cosigner release, most lenders have different repayment options. One repayment option, similar to the federal loans that we just talked about, is you can defer making any payments on your loan while you're in college. And usually then that repayment period will happen 6 months after your student graduates. That's one option. Another option is that while your student is in college, you or your student can just pay the interest every month, as they're going through college. A third option is you can figure out a partial amount of the interest that you can pay. Maybe you can't pay the full interest payment, but you can pay a portion of it. That still helps while they're in college. And a third would be that maybe you just have a fixed amount. Maybe it's just $25. That's all that you can pay, but you're going to be able to pay that every month once the loan starts. So all of these different payment options actually ultimately impact the interest rate that the lender might offer you, and it will ultimately impact the total cost of the loan. Because if you can start paying back the interest sooner, you will accrue less interest over the life of the loan. So but you also have to balance that with, what your cash flow is, and also what your students' monthly payment might be when they graduate college. So these are all the different levers that you can fool with that will impact the interest rate that you're offered, and will ultimately impact the total cost of the loan and what your students' monthly payment will be once they graduate. And the last option that will impact all the things that I just mentioned is how long you're going to take to pay back the loan. Different lenders have different flexibility. Most of the lenders have different options. You can pay it back a short amount of time, or in the 5-year time frame, or not all the lenders let you go out to 15 years, but some do. So you have to look into this level of flexibility on the lenders, and to see what the different term options are that they provide you in deciding to pay back the loans. Chris, anything I missed or you want to add?
Some really good questions being asked
Okay.
right now that I just want to make sure we get a chance to answer. Philip was asking if you can change the repayment choice if your circumstances change. And truthfully, it's very rare for you to be able to do that. So kind of once you have a rate that's set and a structure that's set, that's usually what you're going to be locked into. So one thing to really take into consideration as you're basically doing what Debbie just described and taking a look at what this loan will cost under different options is make sure that if you're choosing a less flexible option, that it's materially cheaper and that you do feel very financially comfortable with, for example, making full payments that start like very soon after the loan is due. Because often, like what we've seen with many lenders is the difference in rate might not be large enough if you start making payments immediately versus if you defer making payments until later. And so you can kind of think of it as it might be okay to take a slightly higher rate sometimes if it provides you with materially more flexibility in that financial choice.
And just something to think about, all of these features that I just mentioned, they're to some and why they impact the interest rate that a lender is going to offer you. If you just kind of sit in their shoes for a minute, the sooner you are willing as a borrower to pay back the loan, then the less risky you become as a borrower and the better the interest rate is the lender is going to offer you. It doesn't mean that you have to, configure the shortest amount of time to pay back the loan and the fact that you'll, start paying it back in full immediately, but just that's the impact of all these different choices on ultimately on the interest rate that the lender is going to provide. The faster you can pay it back and the faster they get their money, you're just become less risky to them. So that's usually how you'll see the range of it's this, for the same creditworthy person, you will get a range of interest rates depending on how you configure your loan.
A bunch of more good questions here. Kenya asking, are you able to get Parent Plus loans for multiple kids in school at the same time? The answer is yes. And to the follow-up there, can you get multiple private loans in your name at the same time? Also, yes. But I just say, depending on the amount of those loans and your income, that the rates might start going up. So just be careful as you make that decision. Allison's asking if it's better to take a loan each year as needed or guess at the whole 4 years. And it's a great question because we do get this a lot. When you're applying for a student loan, it's for that upcoming academic year. You don't actually take out a loan for multiple years at the same time. And on Alan's question of how does the term affect the rate? So generally speaking, to Debbie's point, the shorter the term, the lower the rate, the longer the term, the higher the rate, because that lender also kind of has to lock that money up for longer. And so the longer it's going to take for them to get back their full amount, the more they're typically going to charge you.
So this is just a list of questions that you should keep in mind and get the answers to as you're shopping around and looking at different lenders and looking at different loans. I mentioned the importance of understanding, is there a cosigner release and what the details of that cosigner release are. Can you get an interest rate discount? Most lenders will give you it's about a 25% basis point discount on an interest rate if you set up automatic deductions, of your payment. So, but, just clarify that and make sure that the rate that you're being quoted has that discount, or maybe it doesn't. Let's see, ask about, do you sign the repayment terms? So some lenders give you the choice of the repayment terms and some lenders don't have as many choices. So understand what repayment terms are being quoted when they quote you the interest rates. We already kind of discussed and explained why there might be incentives for taking out a shorter loan. The incentive is likely going to be that you get a better interest rate. Please, I hope that you guys have gotten the importance of understanding figuring out what the total cost of the loan is. It is not you borrowed $10,000 and this is the interest rate, and you're gonna the loan costs you $10,000. Each loan is going to cost obviously more than what you borrow, and each loan, depending on all of the features that you might pick and the interest rate, is going to have a total cost of what that loan comes to when your student has finally paid it off after 10 years. So calculate what that total cost is and make the comparison between loans. Also understand what the monthly payment's going to be. Right now, your student's taking out, loans for just freshman year. And so you'll look at the monthly payment and, it might be doable. But if your student's going to have to take out similar loans for sophomore year, junior year, senior year, well, that loan payment is obviously going to increase. And you should understand what that loan payment, you should forecast what that loan payment will be now, so that you're not over borrowing, and your student's not over borrowing based on what they estimate their potential salary and just lifestyle will be once they graduate. Okay, so timing. We're way into 90 days from when kids are going off to school. We're really in that 60 to 30 day time period, not so much of when students are going to school, but when, as we started this whole conversation, of when the tuition bill is going to come. And from a timing perspective, again, I encourage everybody to start their research and start their shopping. And by shopping, I mean, go out, look at the different lenders and do pre-qualifications, get a better idea, get a more narrow range of what the interest rate is that you're potentially going to be offered. And Chris and I actually talked about this earlier in today in preparation of this session. Kind of, we are in an environment where interest rates are rising. It is out of our control, all of our control. And the likelihood is, I don't know, Chris, if you have numbers of the past month, the interest rate has already increased on student loans, and it is likely, unfortunately, to increase over the next few weeks. So because of that, one recommendation is that you do your research now, and you might actually even want to apply for a loan now before the next potential Fed rate increase happens, which I don't have the date in front of me, but I know it's going to be in a few weeks. Chris, I don't know if you want to talk about how long an interest rate might be valid once a lender provides it, and just some suggestions related to the environment that we're in.
Yeah, thanks for that overview. So I'd say, just to double down on what Debbie was just walking through. Right now, kind of, so at my company, we see a lot of the rates that people are being offered by many different lenders. And so I think over the course of the last 90 days, we've seen the average rate that somebody is getting quoted for a 10-year fixed rate loan go up about 1.5%, which is historic. It's the most that we've kind of seen it go up in any 90-day window. And that pace of increase has slowed down, but it's still going up realistically. And so what we've been encouraging people to do for the last 90 days is to attempt to identify a handful of places you would want to apply and lock in whatever rate you can currently qualify for. Now, that rate won't be available to you forever. Kind of what's going to happen is you're going to apply. You would, to get lock in a rate, you get a hard credit check, and you would be offered, let's say, for example, a 6% 10-year fixed rate. Let's say you liked that. Then your lender would actually talk to the school, and the school would say, yes, this person is actually a student attending this program. And then they're going to get back to the lender and say, this is a valid loan. And from that point on, you're typically going to have about 30 days for that rate to be valid for you to be able to access it. And so some of you might not actually have your tuition due date and your bills yet, but many of you probably do. And in many cases, you'll probably be getting it in the next few weeks. So now is actually a great time to take action, to do rate checks in a marketplace like Debbie was talking about, see what you might get offered and try to lock in something in case rates do continue to climb. And one thing to keep in mind is this is a relatively low risk option because say by some miracle rates flattened and started declining a little bit in a month or 2 months and the money hasn't been sent to the school yet, you could cancel whatever option you've locked in now and reapply for something else if you think that it's likely that there's a lower rate available somewhere else. And so speed is on your side here. And just think about adding an option to your toolkit as you move forward to make this decision.
And there's a lot of questions about people might not know the dollar amount that specifically they need yet. You can call the school and maybe find out what the cost of attendance is that they're projecting for the following academic year. You can overestimate up to the cost of attendance, and then if you need to lower the loan amount, it is much easier to call the lender and say, we are going to need less than what we asked for. It is harder to increase the loan. So, in this time period when, I understand you may not have the final bill yet, but you might want to, follow some of the suggestions that we're making in terms of trying to lock in the rates before they increase. I would just estimate, probably more than you think you might need, and then you can adjust the loan downward once you have the exact numbers.
Yeah, that's exactly right.
Okay, so hopefully by now you've gotten a good enough idea of federal loans, the federal direct loan that the students are going to all max out, the option of a Parent Plus loan, and how you might want to compare a Parent Plus loan to what you could get in the private market. Now I'm going to let Chris explain a little bit more about what Juno does and how that fits into all the information you should be gathering and what you should be looking at before you make a final decision.
Thanks for the intro there. So I'll try to make this quick because I know we're getting a bit later in the evening. But I'll back up and just give you a really quick story for how Juno started and why I'm sitting here today. So almost exactly 4 years ago, I was basically in a group chat that was with me and a few hundred other people who were going to business school in the same class year. And people started comparing student loan rates that they were being offered by many different lenders. We worked together, we built a Google sheet, people put in their credit score range, and we were trying to identify if we could find which lenders would give us lower rates without having to go apply to a bunch of different places. We realized that the rates we were being offered were dramatically different from one place to the next for people with very similar backgrounds. And so one of my classmates and I at that point started an experiment to see if we could bundle together a few hundred of our classmates who also needed to get a loan, and then go ask a lot of different lenders if they'd be willing to provide a bulk discount and better terms to us as a group than we would get on our own. It worked. We were a little bit surprised, but very excited. And for the last 4 years, I've been running a company now called Juno, where our core goal is to help people get access to better rates and terms through the group than they would get if they went to any individual lender directly by themselves. And the way that we do it is that concept of group bargaining. So for about 10 months of the year, we have people who sign up as members of Juno. And what that means is they usually just tell us where they're going to school, what year what their graduation year is, and optionally they'll let us know an estimate for how much they might want to borrow, as well as what range of credit score they have. And then we use that information to basically come up with a big number. So let's say, for example, this past year, we had about 100,000 people representing over $500 million of student loans. And we went to a bunch of different banks and said, hey, who is willing to guarantee the lowest rate to everybody who comes through our channel, as long as they meet your underwriting criteria. And we were really surprised and happy that we found a few that said yes. So what this means is people sign up on our site for free. We don't take any payment information. We can't. And then we have now run this auction process for the last 10 months. But starting tonight, actually, it's the first place that we're showing it. As a result of this process, we're able to guarantee people the lowest rates through a lender that won our auction for this year. And so the way that this process works now is I really like there's marketplaces that are wonderful. In the chat, I was mentioning that Credible is a great place to check your rates across multiple different lenders really quickly. We're trying to build a trust-based organization. So my call to action is to check your rates at different places and not to necessarily trust what I'm saying. But at the end of your process, I would just request that you just check the rates that we're able to offer you. And for an undergraduate student loan, if maybe like to just skip to the next slide here. Here's basically what we're launching as of tonight. If you basically secure a loan through our partner lender, which is a company called Earnest, we'll actually give you 2% of that loan amount as a negative origination fee as cash back. So if it was a $25,000 loan, you'd get $500 and a check that would be sent to you within 30 days of the money being sent to your student school. And if you find a lower rate anywhere else, we have a really simple process where we'll match that rate and add another 1% on top. And so if what I'm saying wasn't true and we didn't have the lowest rate for you, we'll still match that. And to make up for your lost time, we'll give you 3% back instead.
So this is it's really encouraging you to all be good consumers. I can't tell you that Juno has the best rate yet. They say they will, but I want you all to go out there and check the marketplace, see what you can get, and then, prove to Juno whether or not it is the lowest. Either their partner can match it, or if not, they will make sure. I mean, actually, either their partner will give you, an equivalent rate, plus you'll get cash back, or if not, they will actually match it and give you even more cash back.
Yeah, I get a lot of questions often on what's the catch? Is it too good to be true? And the only reason why this works is because we've been really heads down as a team focused on trying to effectively build a union of consumers. And so there's 100,000 people in our group now. It's a really sizable portion of the market. And as a result, we're able to get some of our partners and different lenders to do things that they wouldn't otherwise do. And by kind of bringing a very large group of people to a bank or a credit union at once, we're able to actually reduce the amount that they would have to spend to acquire customers by so much that they're able to engage in this kind of a structure and still not lose money. And so, again, I would say if you have any hesitations about what I'm talking about, please just start elsewhere. Get a sense for what you're able to find on your own. Use the marketplaces to check your rates on multiple places, but give us a shot at the end to just prove our worth to you and that the process works.
Oh, okay, interesting. There's a question here, Chris, about they can't find Juno on their phone. There is no phone. Is there a phone app? But you have to really just go to the website.
Yeah, there's no phone app. So you just go to joinjuno.com on your phone or on your desktop. There's a sign up process there. It takes about 2 minutes. And then what you're going to see is a page that describes what you see on the slide right now. And on that page, there's a link to our partner Earnest. And really important to note, if you use that link, you'll get this rate match and you'll get everything that I'm talking about. If you go to their website directly without our link, you don't get those things. So it's just basically, think of it almost like a AAA discount program that we've been able to negotiate on behalf of the cohort. And it's about as simple as that. We have our own customer service team that's available pretty much all day, every day. And so if there's any questions that you have as you go through, or anything that you're concerned about, or anything you want more clarity on, we will provide that gladly. And we have a few more, I'd say, resources that people find helpful. We have some comparison tools and calculators to help you take a look at what the total cost of your loan would look like, or what the offers you've been provided from many lenders could look like. And if there's anything that we can be helpful with, whether it's helping you build out a budget or helping you forecast what the cost would look like for your loans over 4 years, we love to hear questions like that, and then build tools that we can share with everybody.
So let me just go back and answer a few questions. Allison asked, my daughter's school will only allow one semester to be paid at a time. They will not carry the credit over. If you take amount for fall and spring, is it paid directly to the school, or does it go into the bank account that you draw from? So just so Allison and you and everybody else understand, if you ask to borrow, for the full year, the lender does not disperse the full amount to your school all at once. So in your case, Allison, you might ask to borrow, the full amount that you need for the year, but the school will then contact the lender at different times of the year and ask them for that amount that they might need for first semester and then for second semester. And then you only start accruing interest when the money is dispersed. So again, you might borrow the full amount at the beginning of the year. The school's only going to request at different times the disbursements, and then when the lender sends the money, that's when the interest starts accruing. So again, I wanted to explain that to go back to the point of kind of making sure you have your options available this time of year, and with what's happening in interest rates. I do encourage you to apply. If you need a loan for the full year, apply for the full amount now. Again, as I just explained, you will not be paying interest on the full amount. You will only be paying interest on what is dispersed, and the interest will start at the point that the money is dispersed. And for example, if you request a loan for the full amount and you do not need it for the second half of the year, then you don't have to use the money, but at least you have the availability of the money and you have it at the rate that you locked it in at. Okay. Chris, question about, does Juno have a working relationship with all schools?
Great question. We have a working relationship with all not-for-profit schools in the US, which is the vast majority, and about 150 schools in Canada and Western Europe.
And again, just to reiterate, Veronica was asking, do you go through Earnest directly, or you go through Juno? And you really, even though ultimately the loan might be offered through Earnest, you need to go through Juno to get the deal that's being offered, because it's really, quite honestly, it's the power of the community for the reason why Juno can offer the better deal as opposed to going directly to Earnest. Okay, well, it's a little over an hour. I'm hoping that you guys got good information about loans in general, and really understand how you shop around, you research, you compare, and most importantly, at the end of your comparison process, that you give Juno a shot. Because I don't know, hopefully if you followed me through the whole admissions process, I'm all about helping everybody be a smart consumer, understand what you need to research, understand the questions you need to be asking. And this is kind of the final phase of the process. And I want to make sure that everybody can get the best that they can that's out there. Okay, any other last final comments, Chris, you want to make?
I've seen this question a few times, so I just add, if you want to just do soft checks and see what your rates could look like across a wide variety of lenders, I do recommend checking credible.com. So that'll give you a pretty good sense for what rate ranges you might expect from a number of different lenders. Two of the larger lenders that are not on Credible are directly, at least, are Sallie Mae and
SoFi.
Earnest.
Oh, and I think
SoFi.
SoFi, yeah.
Yeah. And so just know that basically, if you wanted to check the vast majority of lenders, you could just check Credible, check Sallie Mae, check SoFi, and then at the end of that, check, basically go to Juno, because it'll give you, you'll get directed to Earnest, but you'll get basically a better program than if you went directly to Earnest. And so that's maybe a cheat sheet that would help you cover the whole range of options.
And actually, and even easier cheat sheet, if you guys want, is we've sent out an email. It might even be in your inboxes now, summarizing, the process that Chris just described, sharing with you the lenders that you can go to do your first credit checks, and also sharing the link to make sure that you join Juno, and then you'll have the comparison after you've done your other loan shopping. So, and Ben's just asking, so the marketplace to look at is Credible if you want one quick, easy marketplace. But the other lenders that are not on Credible are SoFi, Sallie Mae, and Earnest. Okay. Chris, there is one last question.
Yeah.
There's, I don't know if you want to answer, but and it's fair. I don't know. Becky's asking, how does Juno, how do you make money?
Oh, yeah. Great question. I do not mean to be hiding this at all. So we do get paid a fraction of the total amount of loans to customers that our partners that end up working with. But I really want to make sure that as we structure this, incentives are always aligned. And so we only want to get paid when you're using a product that's actually right for you and the lowest possible cost. So if that's not the case after you go through the process for whatever reason, please do not use it. But if it is the case, I would just ask that you consider using it, and ideally maybe tell one or two other people, because still to this day, over 80% of the people who've ever used it found out about it through a friend or a colleague or a classmate. And that is how we're able to basically, I'd say, aggregate a large group and pass a majority of the savings on to our member base.
So feel free to reach out with questions, reach out to Juno. You guys always know you can reach out to me. You can ask questions in the Paying for College 101 group. You guys are almost there. And hopefully when we can get over this hump, we can talk about fun things like what to pack. So, okay. Well, thank you, Chris. Thanks for putting Juno together, and I'm hoping that everybody, can get a great deal working with you. And thanks everybody tonight. And hopefully you have a better understanding of what you need to do with loans and what to look for and how to make the comparisons. Okay, and watch for our emails, because we're summarizing this information in the emails, and you'll have links to Juno as well there. So in case you didn't take the notes you wanted to take tonight, we always send a recording, and we'll send the summary information in a follow-up email. Thank you, Chris.
Thank you.
Bye.
Thank you. Bye-bye.